The market has been on a strong run this year, and most people assume that means everything is expensive. But that is not how markets actually work. When the average goes up, it does not mean every stock goes up by the same amount. Some companies quietly trade below their fair value, while the headlines focus on those making new highs. Right now, there are 5 stocks worth paying attention to. All 5 have strong analyst conviction behind them. All 5 trade at valuations that do not fully reflect what the businesses are actually worth. And all 5 come from different sectors, which matters if you care about keeping your portfolio balanced. Here is how each one was selected. Every stock had to have a consensus buy rating from Wall Street analysts, with a score of 2.0 or lower. A forward price-to-earnings ratio below the sector average. A PEG ratio below 0.8, meaning genuinely cheap relative to growth. And positive year-to-date performance, meaning the market is not punishing these companies. They are just not getting the credit they deserve yet. First up is Charles Schwab. Most people think of Schwab as a place to open a brokerage account. But the business goes much deeper than that. Banking products, wealth management, advisory services, mortgage loans. It is a full financial platform serving both individual and institutional clients. The stock had a rough patch earlier in the year when a competitor launched an AI tax planning tool and spooked the wealth management space. But the business kept performing and the stock has recovered. It now sits with a high single-digit year-to-date gain that is actually ahead of the financial sector average. The valuation is the interesting part. Schwab trades at 15 times forward earnings, with a PEG of 0.75. And the growth runway is significant. Right now, paid financial advice only reaches about 5% of Schwab retail households. Over 30% say they would be willing to pay for it. The company currently holds 2% of a $37 trillion advice market. There is a long way to run from here. Wall Street has 18 buy ratings on the stock against 3 holds and 1 sell. Analysts project around 20% annual earnings growth over the next 3 to 5 years. That kind of growth at 15 times earnings is a combination worth noticing. Second is Alphabet. Alphabet needs very little introduction. Google Search, YouTube, Google Cloud, and a growing AI infrastructure that is becoming more central to the business every quarter. The company generates cash at a scale that most businesses cannot match, and it has been deploying the cash into AI at a pace that is starting to show up in results. What makes Alphabet interesting from a valuation standpoint is that despite being one of the most recognizable companies on earth, it still trades at a PEG well below 1.0. Advertising revenue remains dominant, and cloud growth continues to accelerate. The AI tools embedded across Google products are increasing engagement and time on platform, which directly supports ad revenue going forward. Analyst conviction here is strong, and the combination of scale, profitability, and reasonable valuation makes this one of the cleaner long-term holds on the list. Third is United Airlines Holdings. Airlines had a difficult stretch earlier in 2026. Fuel prices spiked due to geopolitical tensions, and the whole sector sold off. But United has recovered strongly, and Wall Street is very convicted on this name right now. United is one of the largest airlines in the world by available seats, fleet size, and destinations. And it is several years into a strategic upgrade called United Next, which focuses on cabin improvements and a shift toward larger, more fuel-efficient aircraft. That strategy is delivering across multiple revenue lines, including premium cabins, loyalty programs, cargo, and contracted business. The stock trades at just over 9 times forward earnings, with a PEG of 0.52. Morgan Stanley has an overweight rating and said they would be buyers of any dip. 23 analysts have buy ratings. 2 have holds. 0 have sells. High teens earnings growth is expected over the next few years. At these multiples, for a company this size, the gap between price and value is hard to ignore. Fourth is Meta Platforms. Ticker Meta. Technology sector. Meta nearly collapsed in 2022. The stock dropped over 70%, and the headlines were brutal. Then the business quietly rebuilt itself. Advertising revenue recovered. Costs were cut aggressively. AI tools were embedded across Facebook, Instagram, and WhatsApp. Engagement metrics improved significantly as a result. Today Meta is generating serious cash and trading at a PG that still looks attractive given the earnings growth trajectory. The AI investment cycle that spooked investors a couple of years ago is now paying off in measurable ways. Reality Labs remains a drag, but the core advertising business is strong enough to carry the weight and then some. Analyst consensus remains firmly in buy territory. Fifth is Neurocrine Biosciences. Biopharma stocks are usually expensive. Neurocrine is the exception. The company develops treatments for neurological, psychiatric, endocrine, and immunological disorders. Its main product Ingrezza generated $716 million in revenue in the second quarter of this year, which represents about 75% of total company revenue. The story getting more interesting now is diversification. Two newer drugs, Crenessity and Vykat XR, combined for over $200 million in Q2 revenue. The company is becoming less dependent on a single product, which makes the overall business more resilient. There is a risk worth mentioning. Some medical experts have flagged safety concerns with Vykat XR, including serious adverse events. No causal link has been confirmed, but physician caution is possible in the near term, and that could slow the product launch. The market has already reacted to that concern and pushed the stock lower, which is why Neurocrine now trades at 14 times forward earnings, with a PEG of just 0.33. That is one of the lowest valuations you will find in biopharma. Wall Street has 23 buy ratings against 4 holds and no sells. Long-term earnings growth is projected at 40% annually. Even with the near-term risk factored in, this is an unusually attractive entry point. These 5 stocks cover 5 different sectors, and every single one of them pass strict valuation criteria. On top of that, each one has strong analyst conviction backing it up. That combination is not easy to find in a market like this one. Charles Schwab for financials. Alphabet for technology. United Airlines for industrials. Meta Platforms for tech with a different profile. And Neurocrine Biosciences for healthcare. None of these are guarantees. Do your own research and make decisions based on your own financial situation. But if you have been looking for where the value is hiding in this market, these 5 are a solid place to start. Drop a comment and tell me which one interests you most. Hit subscribe and see you in the next one.